Well, our next guest says stocks are heading higher. They're heading for new highs, in fact. She says things look so good out there. Even her own price target might be too low. Let's bring in Lori Calvasina, the head of U.S. equity strategy at RBC. Lori, welcome back. Good to see you. It may be too low.
Well, we have 2950 as our year-end target, and we ran 7 different scenarios. This is the second highest one, our 2950. We did say, one scenario we could envision of getting the S&P north of 3,000 is if you just see the same kind of rebound this year that you saw in 2010, 2011, 2015, 2016 off those lows. Then the average rally was about 29%. If we get that off December 24th, it could take you a little north of 3,000. That's not our base case, but that's the upside we could potentially
What is the
see.
catalyst, or what are the catalysts for that sort of rebound in this environment?
So I think that you have to go back to December 24th and exactly what was priced in. We think the market came very close to pricing in a recession. And we think that you're basically living through that rough patch now that we already paid the price for. So we think we're in recovery mode. I do think, though, the rally is dependent upon seeing the economic data get better in 2Q. We've got to see signs of further stabilization relatively soon.
So, Lori, we've seen the laggard in financials, which actually is up 8% year to date in the form of the XLF. But do you go for the laggards, or do you go for the things that have performed?
So I wouldn't be chasing technology here. I think that the TIMT space, it's led this year. It's very overvalued. Certain areas like software and services, which are kind of, the defensive parts of tech, the secular growers, so to speak. I wouldn't touch them right now. They're crowded. They're overvalued. I think you've got a lot of deep valuation within financials and banks specifically. They're very closely correlated with the ISM in terms of how they trade. So if you buy the rebound thesis, they should work just as well as the semis already have. And I also think you've got external catalysts coming to financials. They're going to start leading soon on the buyback initiative. Dividends are strong there. We're starting to see flows trend in favor of value. And we've also opened the door to M&A. I think there's a lot of exciting stuff happening there.
Lori, Mike Wilson from Morgan Stanley talks about an earnings recession. I think he reiterated that today. What derails sort of this 2950, 3,000 bull thesis? So
we've got basically 171 as our earnings number for this year and a 17.3 times multiple. That's similar expansion to what you saw in 2006, 2007. I can't really get on board with the earnings recession thesis here. We did some stress tests on our models, and if you have a mild recession, I could see earnings going to 160. But if you just have sluggish growth, I think you'll still get a couple bucks of earnings growth this year. So I just don't see it.
Lori, how are you assessing the Treasury market in the midst of all this? Obviously, equities valuations are a function of a discount rate, et cetera. So there's something very real here. But we've also just seen these overshoots. And I know you also talked about extreme bullishness at one point in one of your notes. How did Treasury figure into your whole assessment?
We keep an eye on it, but I focus mostly on the equity market call at this point in time. I think the yield curve, it is a problem, even with our financials call, and we acknowledge that. But I think there's a legitimate debate out there about whether or not the 10-year and the yield curve itself are really reflecting what's going on with the economy. I'm not quite convinced either way, to be honest, and that's not really what's driving the financial call. I would say what I'm a little more focused on right now for risk signals is actually the CFTC data on equity market futures positioning. And what's interesting there is you can see seeds of a melt-up starting. So we saw it if we looked at the data in March. You saw S&P futures really just kind of turn slightly parabolic in mid-March. Went back to October levels, didn't quite go back to last January's levels. We haven't seen the same follow-through on other contracts like the Dow, the Russell futures, the NASDAQ futures. They're all still very low. But we do need to watch that. I mean, I think we got 2 great sell signals last year from that data. We're not seeing it yet. We do need to keep an eye on it.
Lori, what about, you mentioned this kind of melt up, and it kind of reminds me a little bit of like 1998. It kind of feels like that to me. But we have a presidential election coming up. How does that figure into the equity? It seems like everybody would want the market higher for the election.
Yeah, I mean, yes and no. I mean, we actually, when we go through our 6 drivers of market performance, we say the one negative driver we see, the one big headwind for the S&P directionally is policy, which is our code word for Washington. That had previously been a concern about the trade war. We're getting close to the finish line there. The 2020 elections are a risk factor. I mean, we actually went through and polled our analysts recently, and we said, look at the industry you cover. If the Democrats were to take over Washington, when all 3 have the triumvirate, would that be a risk to your industry, yes or no? And about a third of them said yes. I mean, that's pretty material, and it was across multiple sectors.
Wow. So, Lori, let's say we got a 50 basis point cut. Would that be a positive or a negative for equities?
You know, I think we'd have to see what the backdrop was, but my concern about a big cut is that we'd probably have to materially downgrade our earnings growth forecast. I think the Fed only does a cut that big if you actually are in sort of a borderline recessionary type environment. I don't think they're going to do it if the economy is doing fine. So, you know, maybe markets aren't going to be down materially from where we are, but at the same time, I don't think you can sit here and say there's not going to be some sort of adverse impact on earnings numbers. So you'd have to adjust for that.
Lori, thanks a lot for coming by. Lori Calvasina from RBC. What do you think, Grasso?
So, you know, for me, I would love to chase a laggard, and I'd love to buy the healthcare ETF, but I just can't get around it due to that last policy risk. So you have Democrats and Republicans that are your headwind there. But if you want an underperformer, XLV, see if it can perform.
I still think banks are going to sort of be meandering in this range, just slightly low over the course of the next couple of months. But I do think material stocks might have some tailwinds for the first time in a long time. These steel stocks have had a pretty decent couple days, and I think the rally will continue.